Hey y'all, hope y'all doing well today. We are looking at a Global X Fund, RYLG. A lot of you probably are familiar with the Global X funds, the most popular one going to be the QYLD, the XYLD, and the RYLD. Those are 100% covered call income ETFs. Now the G series, I've actually never done a video on the G series, so we can just kind of call this the QYLG, XYLG, RYLG ETF review because essentially all of them are the same except for the index that they cover. Okay, so let's get into it. For those of you new here, like, share, subscribe, do all that good stuff. Down below in the pinned comment is my Amazon link. Christmas is coming. Bookmark that Amazon link. If you appreciate the work that I do here, it would be appreciated if you can use that Amazon link. Doesn't cost you any extra, but it sends me a few pennies my way. And it's a win-win situation that, you don't have to sign up for anything, that I'm not selling you, BS crap. So I would appreciate that. Thank you. So what are we looking at? RYLG. And essentially we could be looking at, like I said, XYLG and QYLG because they do the exact same things. So RYLG is the Russell 2000 covered call and growth ETF. Why would you consider RYLG? High income potential. RYLG seeks to generate income by writing covered calls on the underlying index. Upside potential by writing calls on 50% of the portfolio. Now, did I just mention that? I'm not sure if I did. The QYLD, RYLD, XYLDs write it on the full value of their portfolio. That's how their options are sold, on the full value of their portfolio. The G funds only do it on 50% of the value of the portfolio. So you get half the income, but along with that, what you also get is half the upside. So RYLG, say if IWM, which is the Russell 2000, I think they use Vanguard's Russell 2000 ETF here though. If it goes up, 10% in a month, the G fund should participate in about 5% of that. The RYLD fund should participate in a much smaller portion of that. Essentially, it's probably less than 1%, but you're going to get the income, the higher income from it. Okay. But what they don't, actually, they do point it out, but what they don't point out here in the front page is that the downside potential is the same or even worse than the RYLD. Okay. That's because you're not getting as much income on the front side. So if the downside happens, you're only getting half the income that RYLD would get, or the D funds would get. I hope that makes sense. And of course, all the income funds mostly, they will make distributions on a monthly basis. Not a whole lot to look here. It just came out October 4th. Expense ratio is 0.60. Net assets under value only 2.54 million. And let's see, is there anything else I want to talk about here? Yes, it is the Vanguard Russell 2000 ETF. They could hold the IWM as well, same thing. And you'll see their holdings, the mini Russell index and the Russell, the big boy Russell index. Reason why they do that is because they're small. Okay. Now, I did mention that the upside downside thing, and I was actually surprised to find an article that kind of explained that. So RYLG coverage percentage, trade-off between growth and income. So this also goes for XYLG and QYLG. Investors must consider multiple factors in deciding the specifics of a covered call strategy. One primary topic to consider is the amount of the portfolio that would be covered by call options. So here we go. This is a great graphic here. So if an investor is fully covered, the fully covered investor would not partake in the gains. So the fully covered ones, what they mean by this is the QYLD, RYLD, XYLD, or yourself, right? If you're running calls yourself and you're writing at the money, if the position that you wrote a call on was at the money and it went up 1%, you don't get the gain. You just get the premium that you took in. If an investor is 50% covered, they would take in 50% of the upside. So, say you had 200 shares of Apple, right? And then essentially what you would do is write a covered call on only 100 of those shares. So 200 of them, or 100 of them would participate in the upside, and then 100 of them would not, right? And here's the decline part. And I'm glad they put this on here. On the opposite side of this, if the underlying stock experiences a 1% decline, the full covered investor, XYLD, RYLD, QYLD, would take part in the decline, but it would be partially offset by the premiums from the option that is received. So just like I just said. And then if the investor is 50% covered, they would actually participate in a greater proportion of the decline, as the 50% covered investors only receives half of the premium amount to offset losses. Now, that's really up to you. I've never been a fan of the G funds. I've said that many a times. That's probably why I never really did a video on it. Because I think, if I'm being completely honest, the ETF, income ETF scene is getting a little ridiculous. There's just way too many stuff. Oh, and that brings me to another note. Those of you looking for the income fund showdown, I am still working on the spreadsheet. I want to make it good. Okay. So it might be a delay, might be even delayed this whole month. But trust me, I'm working on it. So this here is great information. Now, we can look at this. We can't look at this in the RYLD section, but we can look at this in the QYLG section. So here is QYLG, QYLD, and QQQ year to date. Okay, year to date prices. So this one here is the QYLG. It is down. This is just price to price, down 33%. QYLD is down 31%. And the QQQ is down 35%. So even though the QYLG, they tout it as, oh yeah, you're going to get the upside, but you're going to fully participate and even probably more on the downside. Okay. And what I would suggest, if you have the money and you want to do the Russell 2000, I would say buy IWM, the ETF, okay, and run the options yourself. Now, you got to have the money though, but it is extremely more, I don't know if that's grammatically correct, extremely more profitable this way, okay? So let's take a look at an option chain of IWM, which is the Russell 2000. And you'll see, as of today, $166.81. So you'll need $16,681 to buy 100 shares. But if you went out a month and sold a covered call, let's look for 31 days. Here's 31 days out to November 14th. If you sold it at the money, so if you bought the shares and sold it at $167, you would receive right here anywhere between $6.71 times 100 between those two numbers. So let's just say it's, let's go in between. Let's say you get $674, and then let's divide that number by what you would need to buy Russell 2000 of. We times that by 100, you'd get a 4% yield. Okay, times that by 12, 48% yield if of course, you can sell at the money calls every single month. Problem is if the Russell goes down, your cost basis is still here at 166. You either need to, average down by another 100 shares to get your cost basis down so that you can continue to write calls. Now, what you could do is write it out of the money and you'll still come out ahead. Let's see. This only goes up to 171. Let's try to make some money here. Let's get some more strikes up here. Now let's go down back to the 31 days. Okay, where are we at? Here it is. And let's say we sell the 175 strike. Okay, we sold the 175 strike. Let's say we get $318. Divide that by the cost of the shares today and times that by 100. You still get 1.9%, times that by 12. So that's a 22.87% yield. Plus, even if the Russell 2000 were to get up to 175, you participate in all that upside. So not only do you get the $318, you'll get the difference between, let's call it 167 and 175. So you'd get $800. So you participate in the upside. Okay, so there you have it. So instead of getting 600, you'll get 300 plus the 800 in upside if the index goes up. But that is, of course, that's a little bit more advanced, right? This is kind of what I want to get into. It's what I'm doing with the Retire with Less series, which will be coming out next Saturday. Stay tuned for that. And yeah, I mean, if you're a set and forget kind of guy, maybe RYLG, or I'm a bigger fan of these if you were dead set on a G fund, okay, I would say split it up. Like if you got QYLD, I would do QYLD and QQQM. Okay, split up your investments 50-50 there. XYLG, I would do XYLD and VOO and do a 50-50 investment there, right? And then RYLD, I would do IWM and RYLD, do a 50-50 investment there. That way, you're free to just leave the index to run, right? You don't have to have it called away. And you can also run calls on the indexes that you buy as well. So I've just never been a fan of the G funds. That's just no way around that. Not really a big fan of Global X too. I just think they make ETFs, right, to profit themselves. They're not worried about the investor because they got a pretty high expense ratio, 0.6, right? If their ETF fails, no big deal. They still made money. If it's successful, they still make money. So they make money whether they perform well or they don't. And that's not the case with you personally. So that's all I got. What else? I think that's it. Hope you guys enjoyed this. I guess you'd call it a half-ass review of RYLG. Hope you guys enjoyed. Use that Amazon link down below. I'd really appreciate it. Last week's video was a flop. YouTube had some sort of glitch where the video didn't get monetized. So last week's video was pretty much a freebie. Hopefully this one it doesn't end up that way, because I wouldn't end up doing YouTube very much longer if I'm doing freebies all the time. But you guys have been using that Amazon link, and I really appreciate it, because that offset the lost YouTube money. So hope you guys enjoyed. If you got any questions, comments, concerns, leave them down below. Like, share, subscribe, do all that good stuff. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.